despite all the bears roaring today. Boston Fed President Susan Collins said in her first public speech today as a Fed leader that the Fed's need to bring down unacceptably high inflation will cause the jobless rate to rise, something we have not seen materialize in the weekly numbers that we break to you or even in that monthly report. But that question is out there. When are we going to see that effect? And of course, the cause has been the Fed. Now, a recession, not inevitable. There are signs that price pressures may have already peaked, she said. And remember, she's a voting member of the Fed's policy setting committee, and that's going to be this year. I want to bring in Chief Global Strategist for JPMorgan Asset Management, David Kelly. David, it's always great to talk to you on a day like today. I want to start with this news out of the UK, because that really set the tone for markets this morning and in Asia with this language that we got, this tone we got from the Bank of England.
Well, yeah, I think there's sort of two parts to this. One part is that the new government under Liz Truss has introduced this mini budget, which involves a lot of fiscal spending, a lot of pumping money into an economy that's already pretty inflationary, but also it really lacked a lot of details in terms of how the economy was going to evolve over time. And that really, I think, undermined the credibility of the British government to some extent. And what you'd expect to have happen then is you'd want the Bank of England to come in and say, look, we're going to support sterling. We've done this today. We're raising rates today. But instead what they said is, well, we're watching this very closely, and we'll probably do something at our next meeting in early November. I have no idea why they did that. I mean, I think that if you're going to try and deal with a currency problem, you need to deal with it immediately.
I mean, we're talking about the potential collapse of the sterling. Would you be that dramatic about it?
No. I think okay. It'll find a bottom and move up. But I think it's really important that the British government tried to reestablish its credibility here. Sure, this is a policy they want to try to protect people against higher energy prices, but they need to have a long-term fiscal plan, and they need to have some agreement with the Bank of England about how they are going to manage monetary and fiscal policy to actually, help the economy out.
You wrote, David, about the issue with obviously Vladimir Putin in Ukraine and the energy crisis that it's now pushing into the western part of Europe, and that is obviously a dire situation. We're seeing demand destruction as far as global oil goes. We're also seeing those prices lowered here. A lot of different things to unpack there, but I think the biggest takeaway here is that you say, look, between the Russia-Ukraine conflict over there, than what we're seeing here in this country with, mortgage rates above 6%, with inflation at a 40-year high, with, we think, what's going to, like Collins was just saying, I was just giving those comments that she's talking about potentially the job market changing. All of that says recession. All of that. From a market's perspective, what does that say?
Well, first of all, I think it's quite possible that this will amount to a recession. I think the problem is the Federal Reserve is not paying attention to what inflation is likely to do. We know enough about it to know that it is rolling over. It will come down to 3%, and then it'll come down to 2%, and they should be a bit patient here. But I think what markets are recognizing is the Federal Reserve is just so aggressive that they risk tipping the economy into recession. For investors, don't try and time the markets. Don't try and pick the exact day or the hour. You will not know when that is. Look at valuations. At the start of this year, things were priced for perfection. Now they are discounted for disaster. And I think that's a huge change.
So we're oversold. You're saying we're oversold.
Well, yes. I mean, at the start of this year, the forward PE ratio in the S&P 500 was almost 25% above its long-term average. Today, it's 10% lower. So we've actually got a lot of assets on sale. Long-term interest rates have more than doubled, but that means there are good opportunities in the bond market today. So I think people should take a deep breath, realize, whatever's coming in terms of recession or cyclical problems, we'll get through it. But there are a lot of long-term assets which are a lot cheaper today than they were at the start of the year.
Your counterpart at UBS talking about the Fed destroying the U.S. economy. That type of language, I think, gets investors nervous, short and long term, just to be clear. But I think what's interesting here is that as we're looking at a day like today, and it's only Monday, where you've got the S&P retesting and probably giving us a new low for 2022, the Dow in bear market territory, that seems to signal that hyperbole that this is it. And I know we can't time the market, but it feels like we're hitting that low level.
Yeah, well, certainly. The Federal Reserve is not destroying the economy. I think they've made a mistake, and you know what? They'll learn from their mistake, and they will reverse course. And when they do, I mean, there is actually an upside to this for long-term investors, because if they overdo it, they will actually kill wage inflation. They will kill inflation. They'll slow things down. And if you could actually end up in a situation where a year or two from now, they're having to cut rates to low levels again to try to stimulate the economy. And that, if you remember, that's really what really was a basis or a platform for very good asset prices throughout the last decade. So I don't think the Fed should do this. I don't think we need to have a recession, but we have one at the end. When you go through, a few years from now,
sure,
it actually could be a good basis for good stock prices.
Last time that we talked, I was hosting the show, you were here, we talked a lot about emerging markets and international markets. Mm-hmm. You've before in the past said that you like MSCI,
yeah,
certainly those global indexes, but is that an emerging market story? Is that a first world market story? I mean, how do you play that? Is it by region? Is it Asia?
Well, the different stories around the world. I mean, what's happened so far this year is the rest of the world, stocks around the rest of the world have actually fallen by less than the US, a good deal less. The problem is the dollar has just soared up. So in dollar terms, it's been pretty miserable. But I think that there are a lot of things that could go right. I mean, eventually, there may be a change in leadership in Russia. We certainly hope so. Eventually, we'll see a change, I think, in COVID policy out of China. Eventually,
as in they're going to ease the lockdowns there.
I think they will,
that's really hurting a lot of things.
Obviously, there's going to be a massive public health problem when that happens. But eventually, they'll get through it like everybody else does, and then they can get back to growing again. So
I'm not sure lockdowns worked in this country, so I'm not sure it's going to work in China as well. I mean, you've got 1 billion people.
With Omicron, you can't keep the bug contained with lockdowns given Omicron.
Right. So real quick, I do want to ask you about the yield situation here between the 2 and the 10-year. I mean, we were seeing numbers we haven't seen in over a decade for the 2 and the 10-year, the inversion, if you will. I don't want to get too wonky and all of that, but what does that tell you about the bond market?
It tells me the bond market thinks the Fed's overdoing it. The bond market thinks the Federal Reserve is going to raise rates too high, and this is what always happens. They wait too long, then they do too much, and then eventually they have to reverse course, and they should just calm down, take it easy, raise rates slowly. But the bond market just doesn't believe they've got the patience to do that, so they'll be back a year from now cutting rates, and that's what the bond market's telling
I hope everybody enjoyed their summer rally. If you enjoyed summer and you enjoyed your summer rally, here we are today. But we're going to get through it.
This wasn't the last summer in America.
David, good to see you as always.
Anytime.
Thank you very much.